Hey traders, I want to talk to you about diversification and your trading and investments out there. And really, I want to go over the theory of gold and silver diversifying a portfolio. That is old news. And right now, that is incorrect news. Here's a chart of the S&P, right here, the bar chart, and gold and silver, right here, this line chart. You can see just this year alone, in 2019, as the S&P rose, the price in silver rose as well. When the S&P dropped, gold and silver actually dropped here from late April to early June. They're actually moving together. Now, basic economics for all the finance students and economics students out there, you're brought up thinking bonds are inverse of stocks and gold and silver are inverse of stocks. That is not true in today's environment out there. You can have days where stocks are down, where gold and silver are down 1% to 2%. And you can have days where stocks are up and gold and silver is up too. The correlation, it's broken, okay? So what can you do to protect your book? Let's say you're long, okay? Let's say you're long the S&P, maybe some S&P, QQQs, IWMs, Dow names out there. What you can actually do is be like a hedge fund manager. So you're long some stocks and then you're short other stocks. And you can do this just by buying puts. You don't actually have to go and short stocks. So what I'm doing right now with the market at new all-time highs is I'm not going to say, oh, I think the S&P is going to drop 10 or 20% from here. I have no clue and I have no advantage. But I do think retail stocks, especially going in Black Friday and the new year, I think your big box retailers that did make the shift to online, like a Macy's, like a Kohl's, like a Gap, I think they're gonna move lower. So let me put in Macy's here. This is Macy's now on this line chart. Macy's, as stocks have gone up, it has gone lower. That's exactly what I want. So I'm taking that opportunity, especially with the market at new highs here, to say, hey, if, let's say by some chance, stocks roll over, Macy's will roll over and accelerate quickly to the downside. And if stocks continue to go up, well, Macy's can still go down, as it's shown here, especially as the market made new highs off this October big bounce. Macy's has not done a darn thing. And you can see back earlier in the year, while the market was rallying up until May, Macy's was actually moving lower. So Macy's, Kohl's, Gap, these names I took in my book to buy puts in or shorting stock thinking they're going to move lower as the market, well, I have some longs out there, internet security companies, internet software companies out there, select energy names out there. So as the market rallies, I get exposed to the long side. As the market declines, I'm exposed to the downside. That's the whole basis of a hedge fund, of the hedge fund theory, and that's true portfolio diversification, especially if you're a trader or an investor out there. It's not running by golds or utilities or gold and silver or bonds. No, it's having a mixed bag of longs and shorts in your book.